Final accounts and closing entries in accounting. Final accounts. In any accounting process, the final product of accounting is preparing final accounts. One of the most important objective of accounting is to know about the financial position or balance sheet of the concern. Another objective may be to know the profit or loss made by the concern. Final accounts consist of profit and loss account and balance sheet. Summary of income statements comprising of accounts affect the profit and loss of a business concern. The income statement is made up of trading and profit and loss account. First part, being trading account, reveals the gross profit or loss made by the business. The next part, being profit and loss account, reveals the net profit or loss made by the concern. Trading and profit and loss account is prepared for a particular period, normally at the end of the period or the accounting period. Trading account. The formula used to find out the cost of goods sold is the sum of stock at the beginning with purchases, direct expenses, and from the sum, stock at the end is deducted. Sale is calculated based on sale equal to stock in the beginning plus direct expenses plus purchases made plus gross profit minus stock at the end. Business concern where accounting happens may be trading or manufacturing in nature. For trading, direct expenses include all expenses in bringing the goods, in making them ready for sale, including any charges incurred such as cartage, purchase charges, octroi, customs duty, etc. For manufacturing concern, direct expenses include all expenses incurred in the production of goods like power, fuel, wages, factory expenses, along with expenses in bringing the goods to go down, making them ready for sale, etc. Rent and rates normally will not appear in the trading account. It is always better to remember that after preparing the trading account, one knows about the gross profit or the loss of the concern. Profit and loss account. Profit and loss account reveals net profit or loss incurred by the firm. It starts with gross profit or loss incurred in trading account and debits all indirect expenses in the account, which are selling and distribution expenses and administrative expenses. Selling and distribution expenses include discount, commission, advertising charges, and packaging expenses. Administrative and office expenses may include establishment expenses, office salaries, printing and stationery, electric charges, postages, etc. In a profit and loss account, the provision for bad debts is made by crediting debtors account. Interest on capital is also considered expenses for the business. Interest on drawing account, however, is seen as a gain for the business. Balance sheet. A balance sheet is a statement of a financial position of a firm or concern. Balance sheet is normally representative of the equation assets equal to liabilities plus capital. Fixed assets are kept in the business for its use for earning income for a long time. Contingent liabilities are liabilities which are not shown in balance sheet but are shown as footnotes. Some of the examples of contingent liabilities are liabilities incurred in respect of loan guarantee, bills discounted, disputed claims, etc. Profits shown as a liability in balance sheet because the amount is normally considered due to the owners. Profits made from operations that are normal and retained in business is shown under capital, reserves and surplus in balance sheet. Goodwill is considered an intangible asset in balance sheet. Stocks and bills receivable is considered as current asset in balance sheet. Income tax paid by the firm on the income of the proprietor is added to the drawing account of the proprietor. Wages paid when a new machinery is erected is debited to the machinery account. Balances appearing on debit side of trial balance or expenditure is shown in the balance sheet. Generally, the balance sheet of a concern comprises of real and personal accounts only. Closing entries. Closing entries refer to entries passed to close all the income and expenditure accounts, and this generally happens at the end of the accounting period. Closing entries transfers net profit to credit side of capital account and transfers net loss to debit side of capital account. Closing consolidated entries in journal are normally passed for the transfer of purchase and sales return to debit of trading account, transfer of all manufacturing and purchase expenses to debit of trading account, transfer sales and purchases return to credit side of trading account, and transfer of closing stock to credit side of trading account by adjustment entries. Closing entries also do transfer gross loss to debit side of profit and loss account, as well as do transfer gross profit to credit side of profit and loss account. In addition, it also transfers all administrative, selling and financial expenses to debit side of profit and loss account, as well as transfers all operational and non-operational incomes to credit side of profit and loss account.